I'm Daniel.
And I'm Mira.
Imagine watching a historic Middle East peace deal send global crude oil into just an absolute freefall.
Right.
Sparking this massive market relief.
Yeah.
Huge relief, only to turn around and watch the Nasdaq just violently suffocate in a brutal, exhausting 600-point reversal.
I mean, today's market didn't just exhale.
Yeah.
It immediately started hyperventilating.
Exactly. And that's what we're going to unpack in today's deep dive. We're going to look at the global cross currents that set us up for this morning, how the U.S. session just violently digested this geopolitical breakthrough, and the mega cap tech moves that somehow totally defied the gravity of it all.
Yeah, it was wild. And just to be perfectly clear before we jump in, this deep dive is strictly for market context and discussion.
Right.
It is not personal investment advice or recommendation to buy or sell anything.
Always important to state. So session one, what set the stage before the U.S. session?
Well, to understand why the U.S. markets fractured so aggressively today, you really have to look at the massive global cross currents that, set the table while we were sleeping.
Right, mostly in Asia.
Exactly. The epicenter was definitely the Bank of Japan. They formally hiked their short-term interest rate target to 1%.
And that was a 7-to-1 vote, I think?
Yeah, 7-to-1. But here is the catch. Despite this historic rate hike, they opted to maintain their monthly bond purchases.
Near, 2 trillion yen, right?
2 trillion yen, yeah.
Yeah.
Stretching all the way out to April 2027, which is just such a fascinating balancing act.
It really is.
I mean, the Bank of Japan is signaling to the world that they have structural confidence in their economic recovery.
That inflation is finally hitting their targets.
Right. But by keeping that massive bond purchase program intact, they're effectively like handing out airbags before they risk crashing the car. They're terrified of shocking the system.
Well, let me push back on the consensus narrative here for a second.
Go for it.
Because we hear all this talk from analysts about how a BOJ shift like this is, the ultimate trigger for the carry trade unwinding as liquidity drain.
Sure, yeah.
The idea that as Japanese rates rise, that cheap yen that fuels global borrowing just dries up. But if you look at the actual tape today, the U.S. dollar reaction was completely flat.
Literally barely moved.
Right. The dollar index barely drifted. So are traders just shrugging this off, or is the timeline for this liquidity drain much longer than the market wants to admit?
It's absolutely a longer timeline. And, that flat reaction is exactly what the Bank of Japan engineered on purpose.
Okay.
The tape is flat because the central bank is heavily telegraphing every single move.
Right. No surprises.
Exactly.
Yeah.
When you guarantee 2 trillion yen in monthly bond purchases, you flood the system with enough local liquidity to cushion the immediate blow of the rate hike.
So the carry trade unwinding as liquidity drain isn't happening overnight?
No, it's not a sudden earthquake. It's more like a slow, grinding tectonic shift.
Yeah.
The capital flows will alter, just, not on a Tuesday afternoon.
That makes a lot of sense. They're managing the retreat. But moving down to Australia, the central bank there does not have the luxury of a smooth retreat.
Definitely not.
The Reserve Bank of Australia held their cash rate target at 4.35%, but Governor Michelle Bullock's tone was noticeably aggressive.
Very hawkish, yeah.
She explicitly refused to rule out further tightening because core inflation is just remaining incredibly stubborn.
Well, they're looking at the underlying data and realizing that getting from 3% inflation down to that final 2% target,
the last mile,
is the hardest part of the cycle, exactly.
Yeah.
And what makes the RBA's inflation anxiety so palpable is what's happening right next door.
China.
Right. They're fighting domestic inflation while anchored to a massive disinflationary weight in China.
Yeah. The Chinese macro data for May was highly disappointing across the board. We saw a surprise 0.6% year-over-year contraction in retail sales. And the property sector, which is, the traditional engine of Chinese wealth, is still a glaring issue.
Oh, absolutely. New home prices dropped 3.5% annually.
And if you look at major tech hubs like Shenzhen, prices tumbled 4.5%.
Which is huge.
When you think about the mechanics of that, it means the average Chinese consumer is watching their primary source of wealth evaporate.
Right, which completely freezes their discretionary spending.
Exactly.
And that freeze cascades globally. The sustained drag from the Chinese consumer acts as this disinflationary anchor on global growth.
Makes sense.
It severely complicates the picture for multinational corporations, whether they sell luxury bags or industrial equipment. They desperately rely on Chinese demand to pad those profit margins.
So you have deflationary pressures radiating out of Asia, but then you look over at Europe and they're terrified of the exact opposite problem.
Yeah, total paranoia.
Over at the European Central Bank, officials like Chief Economist Philip Lane and Gabriel Makhlouf were out warning that the economic impacts of the recent global energy shocks are far from resolved.
This is a crucial point regarding the mechanics of inflation. The ECB officials are emphasizing the pipeline of inflation.
Right.
They're arguing that the indirect effects on food, goods, and services are still actively materializing.
Because even if wholesale energy prices stabilize.
Exactly. The cost of trucking that food, storing those goods, keeping the lights on in those service centers, it's permanently reset higher.
So that pass-through effect basically guarantees that inflation stays well above their target.
Right. It traps them in what we call a central bank stagflation trap. They absolutely cannot pivot to dovish policy or cut rates aggressively, even if the European growth engine starts to sputter.
Wow. Okay, so if you're a trader waking up this morning, you have this incredibly heavy global setup.
Very heavy.
You have Asian monetary tightening, a deeply weak Chinese consumer exporting deflation, and European central bankers paralyzed by stagflation paranoia.
A fun morning.
Yeah. Let's take a quick break, and when we come back, we'll dive into how the U.S. session violently digested all of this.
Sounds good.
Okay, we are back. Session 2. What moved markets during U.S. trading hours?
Well, when the opening bell actually rang in the U.S. today, all of that macro theory we just talked about was immediately hijacked by the physical reality of what was happening in the Strait of Hormuz.
Unquestionably. The dominant catalyst for the U.S. session was the finalized U.S. Iran peace deal.
Right, which is officially scheduled for a Friday signing in Switzerland.
But the market doesn't wait for ink on a page.
Never does. The immediate physical impacts are already in motion. The U.S. naval blockade has been officially lifted.
Which is huge.
Yeah, and Iranian media, corroborated by U.S. officials, confirmed that commercial ships and massive vital oil tankers are currently transiting the Strait of Hormuz.
Opening a massive geopolitical relief valve. We literally saw the violent unwinding of the energy shock as delayed consumer tax today.
Oh, completely.
When the shipping lanes opened, we saw the U.S. crude benchmark, WTI, just fall off an absolute cliff.
It aggressively sold off from $81.40 all the way down to an intraday low of $74.98.
That is a brutal, almost 8% drop.
Yeah, before it recovered slightly to close at $75.82. But an 8% intraday drop in crude oil is a seismic event.
Right.
For inflation-wary markets, it removes the single largest macroeconomic tail risk of 2026.
Because cheaper oil fundamentally lowers the input costs for virtually every sector of the physical economy.
Exactly.
But the region is not completely quiet, which brings a very strange nuance to this tape.
Yeah, it's messy.
Despite this broader peace framework with Iran, we saw violent cross-border clashes actively intensify between Israel and Hezbollah.
Right, the IDF was actively intercepting rocket salvos from southern Lebanon today.
And Iran is explicitly threatening to kill the nuclear deal entirely if Israel doesn't withdraw from Lebanon. Meanwhile, President Trump brushed it off, calling it a minor war that won't derail the deal.
It creates a wildly confusing narrative. You have algorithms and traders trying to price in a historic peace deal that lowers energy costs right alongside active cross-border rocket fire that could ignite a regional war.
Well, if you look at this through a game theoretic lens, you have to ask yourself if we're misinterpreting the violence.
How so?
I think we have to challenge this reflex to view these border skirmishes as unpredictable, chaotic, natural disasters. To me, this tension is classic geopolitical brinkmanship as bargaining leverage.
Oh, interesting.
It's a highly calculated move by hardliners on both sides, trying to secure the absolute maximum leverage right before the final documents are signed in Switzerland. They are violently posturing to see who blinks first.
Calculated brinkmanship, maybe. But the market cannot algorithmically price bluffs.
Fair point.
You might logically assume it's just posturing, but traders aren't willing to bet their portfolios on the assumption that hardliners won't accidentally cross a red line and start an actual war.
Right, human error.
Exactly. That's why we saw flight to safety assets catch a bid today. Gold had wild two-way volatility, catching an intraday bid all the way up to $4,375.90.
Wow.
Before settling at $4,353 flat. Gold is actively pricing in the reality that humans miscalculate and peace deals can fall apart.
That is a very fair counterpoint. The market demands a risk premium. And while oil was pricing in this massive geopolitical relief, it acted just like that economic X-ray we mentioned at the start of the show.
Yes, stripping away the noise.
Right. By removing the fear of $100 oil, the market was suddenly forced to look at the underlying domestic economy. And the data there was painting a terrifying picture.
It really was. The U.S. housing data released today was a complete disaster.
Awful.
Housing starts plummeted a shocking 15.4% to a 1.177 million annualized rate. This completely missed the consensus forecast by a mile.
And when you think about how housing starts actually work, it's not just a number on a spreadsheet.
No, it's literal lumber, copper, concrete, and construction jobs.
A 15.4% drop is a massive physical halt in economic activity. It proves that the discount rate as financial gravity is actively crushing rate-sensitive sectors. The higher borrowing costs are quite literally freezing construction financing.
And just to complicate the Federal Reserve's life even more.
As if they needed it.
Right. While housing is stalling out and flashing recessionary warning signs, U.S. import prices ran unexpectedly hot, coming in at plus 1.9%.
Oof.
So you have a stalling physical economy paired with sticky import inflation.
Which perfectly explains the absolute exhaustion and extreme whiplash we saw in the equity tape today. I mean, the S&P 500 closed near its session lows at 7,511.35.
But the Nasdaq was the real roller coaster.
Oh, absolutely. It rallied early, hitting an intraday high of 30,940.25, seemingly celebrating the drop in oil.
Right.
And then it just violently broke. It shed over 600 points from that peak to close at 30,300.50.
The Nasdaq's reversal perfectly reflects a market that is fundamentally torn. Investors felt profound relief over normalizing energy markets. But when they looked at the weak housing data and remembered the stagflationary warnings out of Europe,
the anxiety kicks in.
Exactly. Mounting anxiety took over. They started questioning the sustainability of these extremely high mega-cap valuations in a slowing physical economy.
Definitely. Let's take another quick break, and then we'll get into the corporate events that somehow survived this volatility.
See you in a bit.
All right, we are back. Session 3. What's our corporate events recap, and what do we watch next?
Well, not everything was bleeding out today. If you looked at certain pockets of the corporate tape, you'd think we were in an absolute boom cycle, completely detached from the physical economy.
We have to talk about SpaceX.
We do. The public market dominance of SpaceX right now is truly staggering. Shares jumped 20% today.
20%.
That single-day move added $412 billion in market value, propelling SpaceX past Amazon to become the world's 5th most valuable company.
It's hard to even wrap your head around those numbers.
It really is.
And the risk appetite driving it is just hyper-aggressive. We saw over 500,000 options contracts change hands in the very first hour of trading alone.
Wow.
When you have that kind of volume, market makers are forced to aggressively hedge their positions, which, only adds fuel to the volatility.
Right. And this historic valuation shift underscores the market's absolute obsession with transformational technology. It directly connects to the broader theme we keep seeing, AI CapEx as cycle-agnostic arms race.
Definitely.
The enterprise integration is moving so fast that companies are ignoring the macroeconomic noise. We saw reports today that Microsoft is weighing the integration of DeepSeek, which just secured over $7 billion in funding, by the way.
Incredibly.
They want to integrate it into their Copilot software.
Right. And Hewlett-Packard Enterprise announced a much closer AI server collaboration with NVIDIA. The demand for physical hardware to run these models is insatiable.
And speaking of NVIDIA, they launched a massive debt offering today.
Oh.
They originally aimed for $20 billion, but they upsized it to $25 billion because they had a staggering $85 billion in investor demand.
Just casually tossing around billions.
Yeah.
It is absolute proof that mega CapEx as market fragility mask is still fully operational.
Completely.
I mean, these massive tech firms are generating and raising so much cash to build out physical infrastructure that their sheer market weight is masking the underlying weakness we saw earlier in domestic housing and consumer retail.
Exactly. The sheer scale of capital required to sustain current generative AI capabilities is mind-blowing.
Yeah.
And investors are throwing money at it regardless of what the broader economy is doing.
Well, folks, we survived a day where crude oil dropped faster than U.S. housing starts, and the Strait of Hormuz is finally looking less congested than NVIDIA's new $25 billion debt offering. If your portfolio is feeling a little dizzy after the Nasdaq's 600-point intraday nosedive, just remember to look up. After all, if SpaceX can casually add $412 billion in market value and surpass Amazon in a single morning, maybe your battered tech calls still have a chance to reach orbit.
We can hope.
So ring that closing bell, cancel your doomsday bunkers now that the naval blockade is over, and go enjoy the cheaper gas.
Honestly, cheaper gas is the one thing everyone can actually agree on today.
Very true.
But looking ahead to tomorrow, Wednesday, June 17, the economic docket is incredibly heavy.
What exactly are we watching?
The day kicks off at 8:30 a.m. Eastern Time with May retail sales, which is a massive read on consumer growth.
Very important.
Then at 10 a.m. Eastern, we get May pending home sales and April business inventories. But the absolute main event is the Federal Reserve. We get the FOMC policy statement at 2 p.m. Eastern Time.
Okay.
Followed by Fed Chair Kevin Warsh's press conference at 2:30 p.m. Eastern Time.
That press conference is going to dictate the close tomorrow, without a doubt.